This is section 8.4, part 2. We left off with investments. When depositing money into a bank account, you are making a cash investment. The account's interest rate guarantees a certain percent increase in your investment. This is called the return. So, what you're doing when you make an investment is you're allowing the bank to use your money. In exchange for using your money, they give you something back, and that's called the return, aka interest. Other kind of investments that are riskier are called stocks and bonds. If you put money in a bank, it's pretty safe. That's actually guaranteed by the federal government. If the bank fails, then somebody else steps in and says, no, you're still going to get your money, or at least most of your money. Investors purchase stock or shares of ownership in a company. Stock is an actual ownership of a company. For example, if a company has issued a total of 1 million shares, an investor owns 20,000 of these shares, then the investor owns 2% of the company. Any investor who owns some percentage of the company is called a shareholder. Buying or selling stocks is called trading, and stocks are traded on a stock exchange. For example, the New York Stock Exchange. There are two ways to make money by investing in stock. One way is you sell shares for more money than you paid for them, in which case you have a capital gain on the sale of the stock. So let's say you bought one share and you paid $20 for it. That was the cost for that one share. But then the next day you sold your one share for $50. Okay, so you paid $20, but you sold it for $50. You had a capital gain of $30. While you own the stock, the company distributes all or part of its profits to shareholders as dividends. So let's suppose you still own this share for $20, but the company made so much money they decided to share the wealth. So they divide up their profits and they give some of the profits to each of the shareholders for as many shares as you have. When they do this, that's called a dividend or dividends. Sometimes companies do not want to actually sell ownership in the company, but they still need to raise money. So they sell bonds. In order to raise money and not dilute the ownership of current stockholders, companies sell bonds. Basically what a bond is regular people are lending money, making a loan to the company, and the company has to pay them back, plus interest. Bonds are a commitment from a company to pay the price an investor pays for the bond. So let's say a regular person buys a $100 bond. That means the company is willing to give you that $100 back, and that the price that you pay for it, that's called the face value, and the company is also going to give you interest at a particular rate. Okay, so in this case, you, a regular person, can think of yourself as a bank loaning money, and you will get interest on that money that you loan. You will get that money back. A listing of all the investments that a person holds is called a financial portfolio. So let's say you own some bonds and you own some stocks. The stocks and bonds that you own in any given company or companies, that's called your financial portfolio. Most financial advisors recommend a portfolio with a mixture of low risk and high risk investments. This is called a diversified portfolio. Bonds typically are low risk and stocks are usually higher risk, and some stocks are much higher risk than others. There's just about no such thing as a daily newspaper anymore. But if you happen to see a stock table, it has a lot of abbreviations that nobody knows other than somebody who's actually a stockbroker. So let's talk about what some of those abbreviations are. 52-week high, that's actually exactly what you think it is. It's the highest price company traded during the past 52 weeks. Remember, this is stocks. 52-week low, the lowest price that somebody paid for a particular stock in the last 52 weeks. Remember, 52 weeks in a year, so we're talking about the last year. When it says stock, they're talking about the actual company name. If you see this, SYM, that refers to the symbol that the company uses for trading. It's an abbreviation, but every company has to have a different symbol, so you can't have two different symbols for the same company. DIV stands for the dividends that company paid to the stockholders. So if a company actually made money and they paid dividends, that would show up here. If they didn't make any money, then obviously they would not be paying any dividends. This stands for the percent yield. This is the sales volume in hundreds. So whatever this number is, you multiply by 100, and that will give you how many stocks were sold. High stands for the highest price yesterday. Low stands for the lowest price yesterday. Close stands for the price at close yesterday. Net change is how much it changed from yesterday to the day before. PE stands for price to earnings ratio, and there's a formula for that. You take yesterday's closing price and divide it by annual earnings per share. So PE is equal to, I'm going to call this closing price, and I'm going to call this annual earnings. Okay, so if it's asking for annual earnings, you have to solve for that variable. So multiply both sides by annual earnings. Okay, that crosses out. But you still don't have annual earnings by itself. So right now you have annual earnings times the PE ratio is equal to yesterday's closing price. And to get this variable by itself, you divide by the PE ratio. So I think in your homework they ask you actually for the annual earnings. So to calculate that, you take the closing price divided by the PE ratio, price to earnings ratio. Use a stock table for Disney. What were the high and low prices? If you own 3,000 shares, what dividend did you receive? Annual return for dividends. How does the company compare to a bank account offering a 3.5% interest rate? How many shares of Disney were traded yesterday? That's the volume. What were the high and low prices? What was the stock at which Disney shares traded when the stock exchange closed? If you have ... in the net change column, what does that mean? And compute the annual earnings. All right, so remember you have the PE ratio, which is the closing price divided by the annual earnings, but that's not what we're looking for. We're looking for annual earnings. So you take closing price divided by the PE ratio. Anyway, this is that's pretty straightforward. 52-week high, 52-week low. This is the name of the company. This is the symbol they use to trade under. Dividends, percent yield. We're going to use this in this formula right there. This, remember, if it says 100S, that means you got to multiply this number by 100 to get the sales volume. High for yesterday, low for yesterday, closed for yesterday, what the price was at closing, ... means there was no net change. This is the same stuff in words. So 52-week high was 42.38, 52-week low was 22.50. To find the dividends, you had, that's 21 cents for every share that you own. If you own 3,000 shares, you would take that and multiply, and the company paid you $630 in profit in their company. Percent yield was 0.6%. Not a very good return on your investment if you can put your money in the bank account that pays 3.5% interest. Remember, you have to multiply that number by 100 in order to get the volume of the number of shares that were sold yesterday. The high yesterday was 32.50. The low yesterday was 31.25. At close, it was 32.50. And we already talked about this. The ... means there was no change 2 days ago to yesterday. So again, we talked about all this when we were looking at this chart here. Annual earnings, you take the closing price divided by the PE ratio, and that will give you 76 cents. So the annual earnings per share, that's always per share, is 76 cents. So if you owned 3,000 shares, then that would tell you your annual earnings total. And for the homework, I want you to do 2 through 20 even. I also want you to do 28 and 34.